I would say for loans that are falling apart, typically it's going to fall apart at the underwriting stage, and typically why this is the case in the depending on who the lender is a lot of times a loan officer will be having a verbal conversation with a client. They go, "Hey, how much do you make? Oh, you make X amount. I'm going to put that down on an application." I might get a pay stub that I halfway look at, and it goes to kind of confirm what that looks like. And
Right.
then once we get verification of employment, once income calculation forms start to get filled out, once the loan actually has to get submitted to the underwriter, it starts to come off the wheels there. Or maybe
Things
depending on
change. Yeah.
a structure, it gets sent into underwriting one
Right.
form or fashion, and then an underwriter is actually looking at it and going like, "Where'd you come up with this?" Like
Right.
the
Right.
you said they made $100,000 a year, and I'm coming up with like 60. I don't
Right.
know
Right.
how that actually works. So,
Right.
I mean, I'd say that at that stage in the process, which
Yeah.
at least for us and our perfect loan process, as we like to coin a phrase,
Right.
we we like to get our loan in and out of underwriting in the first week of escrow, which means we're in, we're out, and if there's any questions or concerns, that gets addressed early
Really. Yeah.
early in the process.
Yeah. So two things that you touched on. So one, I want to touch on the rescue lender point, but then also I want to touch on first. So, and you kind of said it, the perfect loan process. How do we recognize and kind of do those things up front? What are some specific things that can be done up front so that you are having that perfect loan process and you can avoid those mistakes?